This morning, the Bank of Canada fired a warning shot in its latest brand new monetary policy report. In plain language, the bank is telling us that the Canadian economy has been permanently damaged. Not slowed, not cooling, but damaged. Bluntly, the report says the trade conflict with the U.S. has pushed our economy onto a lower long-term path. Growth has stalled, investment has dried up, the job market is cracking under pressure, exports have fallen, unemployment is climbing. And I think the worst thing, the most worrying thing about this is the bank admits that there is nothing that monetary policy can even do to reverse it. So today, I'm going to unpack just how severe this report really is. I'm going to break this down into 8 parts, try and make it digestible. First off, at the center of this report is a single number that deserves our attention. The average U.S. tariff on Canadian goods has jumped from 0.1% at the start of this year to nearly 6% today. Now, 6% might not sound like a huge number, but then you got to realize that it's 60 times higher than it was the beginning of this year. The U.S. has slapped 50% tariffs on Canadian steel and aluminum and 25% tariffs on vehicles and parts, even those parts that are technically qualified as exemptions under the Canada-U.S.-Mexico trade deal. The result here, exports have cratered, down roughly 5% year over year. GDP shrank 1.6% in the second quarter of this year. Now, for a country that depends so much on the U.S., about 3/4 of our exports, this is a structural disaster. And I want to talk more about that, the structural damage. The bank estimates that these trade shocks are going to leave our economy permanently smaller than it would have been, about 1.5% smaller by 2026. Half of that loss comes from lower productivity and potential output. That means that the economy's capacity to grow has physically shrunk. The rest of that comes from weaker demand, businesses pulling back investment, consumers spending less, and foreign buyers choosing someone else's goods. Key point here is that tariffs don't just slow trade, they end up rerouting it. So companies now, they're reconfiguring their supply chains, they're shifting their production, and in some cases, they're actually just writing off perfectly good equipment because it's now just too expensive to actually even use. Now, the report goes on. It warns that this process, the relocation of labor and capital, is going to drag on for years, and it can't be fixed by lower interest rates. Monetary policy can help. It can maybe ease the pain a bit, but it's not going to rebuild an economy that is structurally wired. In plain English, even if the Bank of Canada cuts their rates to 0, that's not going to bring back the lost trade relationships. That takes me to part 3, the jobs problem. When factories lose orders, what do you think is going to happen? Well, you're going to see job losses. Employment in sectors that are heavily reliant on U.S. demand, like auto, steel, aluminum, they've already fallen sharply. The national unemployment rate now sits at 7.1%. It's been sitting there for the past 2 months. That is the highest since 2016 if you ignore the pandemic years. Most interesting here, this is a bit alarming, is that this is not a classic recession story. That's what you'd expect to see. There is no financial crisis on right now. There's no oil crash. This is a policy-driven shock. Then you add to that lower population growth, which we're going to get to in just a second. Canada now needs to create only about 5,000 jobs a month to maintain the employment rate. And that is down from 60,000 a month just a couple of years ago. So, and the result of that is that even small layoffs are going to look pretty big in today's labor market. That takes me to part 4, which is the current demographic challenges. And I'm sure that you will remember the immigration surge that we had just recently. It boosted our growth coming out of the pandemic. That is officially over. The bank now expects population growth to collapse from 3.3% in 2024 to just about 0.5% by 2026. Now, that is the slowest pace in over 2 decades, and it matters because population growth has been doing most of the heavy lifting for GDP since we came out of the COVID era. Fewer people, that means lower demand for housing, fewer new workers, lower tax revenue, but it also means less inflation pressure, at least in theory. When you look at it in reality, in practice though, fewer workers, it can also mean shortages. Shortages can keep prices elevated even in a weak economy. It is one of those paradoxes that the central banks love to talk about. A slower economy that somehow won't stop inflating. And that takes me to part 5, which is inflation. So let's talk prices here. Even though we're seeing falling output, we're seeing rising unemployment, core inflation is stuck around 3%. So that is not a massive number, but it is not normal for economy that is slowing. A big part of this reason, of course, here is tariffs. They push up the cost of imported goods and inputs. On this chart here, the blue bars are for services, the yellow portion are goods, and you can see those rising for the past few months. Shelter costs are another. Rent inflation came in at 4.8% in September. And although mortgage interest costs have started to come down a little bit, they remain a pretty severe drag on household budgets overall. The bank expects inflation now to dip slightly to around 2% in early 2026 and then stabilize back at target. As you can see here, shelter makes up a big chunk of that number. Those are the orange parts on the bars. So that is one thing. But the bigger story here is how difficult it has actually been to get here. Even with the higher unemployment, even with the weaker wages we're seeing, even with that shrinking trade, prices aren't falling that much. We are seeing inflation without growth. And that is probably the most troubling economic combo possible. If you really want to dig into the danger of this scenario, I will link a video here that I posted recently that talks specifically about stagflation. Now, part 6 of this talk today is the global context. We always have to put things into global context. This is not just Canada's problem. Look at this stunning chart. The US has effectively revived the essence of the Smoot-Hawley Tariff Act of 1930. Its average tariff rate is now 17%. That is the highest in more than 80 years. So just let that sink in for a moment. We are back to the Great Depression levels of trade barriers, and that is up from just above 2% at the start of 2025. So the result here is that we are seeing a global rerouting of trade flows. We're seeing exporters bypassing the US where they can, investing in new markets, and they're paying higher costs when they have no other choice. According to the bank report here, the global economy has so far been resilient, but clearly growth is slowing. Global GDP is projected to average 2.5% in late 2025, down from just over 3% earlier in the year. In other words, here, the world's economy is holding up, but it's definitely feeling strain. Now, we want to look at the limits of monetary policy. I've arrived at the part here where things get very real. The Bank of Canada openly admits in this report that there's not much they can do about any of this. To quote the report, monetary policy cannot offset the long-term implications of U.S. tariffs or other sources of structural change. When I translate that, it says we can control inflation, but not the global trade order. And that is a very important distinction. For decades, central banks have been the go-to problem solvers whenever the economy runs into rough patches. But now tariffs, demographics, these cultural shocks, they're outside of the traditional toolkit that the Bank of Canada will have. You can cut interest rates for sure, cut them all you want. But if we have that 25% tariff blocking your exports, then lowering those costs isn't going to make your goods competitive again. So we have to be clear, the bank isn't even promising a soft landing here. They have lowered our expectations to a very low level. So part 8, where does this leave us? Well, the bank expects GDP to grow to 0.75% the back half of 2025 and then crawl to 1.4% annually through 2026 and 2027. So let's put that into perspective. It is less than half the average growth rate in Canada before the pandemic. Inflation, as I mentioned, is hovering near 2%. Not too high to panic about, but it certainly is not low enough either to ease the pressure that the bank is feeling. We've got weak investment. Housing is still constrained by supply bottlenecks. The labor market is suffering. Yet, as this chart shows us here, wage growth has already fallen to about 3%. So that means that real incomes are barely rising. Again, directly from the report, the bank sums it up in one line. The ongoing trade conflict is fundamentally reshaping Canada's economy and will have a lasting negative impact on economic activity. That is central bank speak, for this is not a temporary problem. So, today's Bank of Canada is nothing short of sobering. It is telling us that Canada is entering a slower, smaller, more uncertain phase of our economic story. Most importantly here, it's not one that is being shaped by the traditional recession cycle. It's actually being shaped by these structural limits, and that is much, much harder to fix. What do you think? Let me know what your thoughts are below. As always, I say thank you for watching. Don't forget to subscribe. We'll see you in the next video.